My name is Andrew Stotts of the Valuation Master Class, and today we have another great presentation. And I can't wait to see this one. Today we're going to be listening to Yash give his presentation about the Walt Disney Company. Do you own Walt Disney? Have you thought about buying it? Or maybe some people have been thinking about selling it recently. Well, in this valuation, Yash is going to tell us his thoughts on whether to be a buyer or a seller of Walt Disney. So without further ado, let me bring Yash in here. Yash, how are you?
I'm good. How about you?
I'm excellent. I'm very excited to listen to what you've got to say. So let me first bring up your report. You see your report there?
Yeah.
Okay. So what I'm going to do is I'm going to leave the screen and then I want you to take it over and run with it. Okay?
Okay.
Let's go. I'm leaving now.
All right. Thank you, Andrew. Hi, guys. My name is Yash, and I'm here to present my report on Disney. So let's start. Not so Disney-esque story, is it? I initiate coverage on Disney with a sell recommendation based on a target price of $70, implying a downside of 26%. I derived this target price from a DCF-based valuation using a WACC of 8.8% and a terminal growth rate of 2%. Highlights are entertainment market fatigue with franchisees, reboots, and spin offs, poor and hasty decision making left a tough position, challenges in the expansion beyond America. Some of the risks are economic and market conditions, highly competitive field, high dependency on a single segment, cybersecurity threats, and ongoing CEO succession planning. Let's move on to the background of the company. The Walt Disney Company, founded in 1923, has evolved into a global entertainment leader with a market capitalization of approximately $170 billion. Its diverse revenue stream are divided into three segments: sports, entertainment, and experiences. Now we move on to the stories. Desperate to stay afloat. Entertainment market fatigue with franchisees, reboots, and spin offs. Disney's heavy dependence on its established franchisees, particularly Marvel and Star Wars, has led to a noticeable audience fatigue. This over reliance on sequels, spin offs, and reboots rather than original content has diminished excitement among fans, making Disney appear repetitive. In 2019, Disney film grossed approximately $13 billion at the global box office, while in 2023, Disney films collectively earned approximately $4 billion at the global box office. Currently, only 11% of profit is coming from the entertainment segment, and I anticipate it to get even less since most of their upcoming projects are also based on franchisees, reboots, and spin offs. Poor and hasty decision making left Disney in a tough position. Since 2021, Disney's share price has fallen by over 50%. The decline is largely attributed to management's questionable decision making. In 2020, Disney ceased paying dividends despite the recovery in 2021. They continued withholding dividends till 2023. Now the company has implemented share buybacks worth $3 billion and reinstated dividends at $0.90 per share in a single fiscal year 2024. Unfortunately, these actions appear more like desperate measure to regain investors' trust rather than a proactive strategy. I anticipate the share price to see at least a 25% more downside since Disney is undergoing one more CEO transition in 3 years, which is indeed a hasty decision according to me. Challenges in the expansion beyond America. Disney's efforts to expand its presence outside of the America stem from the saturation of its primary US market, which currently generates about 80% of its revenue. While global expansion could offer long term benefits, short term returns are expected to be minimal. The company is investing heavily in international markets and theme park expansions, projecting over $60 billion in investments across various projects over the next decade. However, these initiatives may not immediately translate into profitability, leaving Disney vulnerable to stagnation in an increasingly competitive landscape. I am anticipating that Disney's revenue will increase by at least 50% to $27 billion for Europe and Asia combined in the coming 10 years. Now let's move on to the quarter report. In third quarter 2024, Disney experienced a slight revenue increase of 3.7% year over year. The company saw an 11% year over year increase in gross profit and a higher year over year increase in EBIT of 32%. These are some of the latest news. We will come back to that later. Now let's talk about the constraints to growth. There are four main ingredients for constraints to growth: capital, operations, market, and people. They are ranked from major to minor constraints. Capital, minor. Disney's finance structure is sound with a notable decrease in net to debt equity from 66% to 44% by September 2023. Additionally, Disney's cash conversion cycle days have been negative, which suggests that they have been in a strong market position. Operations, neutral. The trends indicate ongoing improvement in this area, with the operating profit margin rising from 5.8% in 2020 to 11.6% in past 12 months. The asset turnover ratio improved from 33% to 45%, and the return on assets increased from 1.5% to 3.6%. Market, major. Disney's growth is significantly constrained by several market challenges, including audience fatigue and increased competition from streaming giants such as Netflix and Amazon. Additionally, changing consumer preferences, particularly the shift towards different immersive experiences rather than Disney's immersive experiences due to hefty pricing, have negatively impacted revenue. While emerging markets offer new avenues for the expansion, market saturation in developed regions poses a major constraint to market growth. People, major. Recent round of layoffs, including the termination of approximately 7,000 employees in 2023 and an additional 300 workers in 2024, illustrates the challenge Disney faces in managing its workforce during times of restructuring and cost cutting. Let's talk about the revenue structure. Disney's revenue streams are diverse, with the entertainment, sports, and the experience segment. In 2023, the company reported total revenue of $89 billion, reflecting a 7% increase compared to 2022. The entertainment segment contributed $41 billion, up by 3% from the previous year. The sports segment, however, saw a slight decline of 1% with a revenue of $17 billion. The most significant growth came from the experience segment, with revenue surging 16% to $33 billion. The company generates most of its revenue from the Americas, approximately $71 billion. Europe and Asia Pacific contributed $10 billion and $8 billion respectively. Let's talk about the FBMR, which is fundamentals, valuation, momentum, and risk. Disney ranks in 8th quartile among 1,800 non-financial companies in the USA, placing in the top 80%. Fundamentals ranked in the 7th quartile in the past 12 months. Disney's operating profit margin reached from 11.6%, up from 7.3% in 2022. Valuation ranked in the 5th quartile. Disney's price to earning ratio has steadily declined. Momentum for Disney has been inconsistent, ranking them in the 4th quartile. And if we talk about risk, net debt to equity ratio decreased from 66% in 2020 to 44% past 12 months. Beta has dropped from 0.7 dropped to 0.7%, indicating lower market risk. Now let's talk about the Porter's 5 for the company. Remember, answer range is 1 to 5, and 1 is strongly yes and 5 is strongly no. Ranking for the company is 56%, that is just above the average. And now let's talk about the variables. Rivalry among competitors, which is scored below average. And let's see some of the questions. Are there many competitors of roughly equal size? The score is 2. Some competitors in the entertainment industry are roughly equal in size to Disney. However, due to Disney's diverse operations, including film, TV, theme parks, and consumer products, competitors may not match its size across all areas of business. Is it a slow growth industry? The industry may not be experiencing explosive growth, although it is not extremely slow either. That's why the score is 2. And is there some technological disruption going on within the industry? The telecom industry is experiencing significant disruptions due to rising consumer expectations, competitions from OTT services, and the integration of digital technologies like AI and cloud solutions. That's why the score is 2. Now let's move on to power versus suppliers and bargaining power versus customers. For the bargaining power versus suppliers, Disney is above the average and scored 67%, while bargaining power versus customers, Disney is facing a problem since they are below average here. Let's talk about some of the questions from bargaining power versus customers. Do the customers have many alternatives? Customers have numerous alternatives to Disney's offering, which contributes to a competitive environment for the company. That's why the score is 2. Can the customers put pressure on the supplying companies? Customers have significant power to influence suppliers through their demand for quality, customization, and competitive pricing. The ability to switch suppliers easily further enhance this power. Let's talk about the threat of new entrants and threat of substitutes. Threat of new entrants, Disney has scored a 93%, which is really good for the company. While for the threat of substitutes, it's a really big issue for the company. They have scored just 33%. And let's talk about some of the issues. Are the customer switching costs low? Disney operates in a highly competitive media and entertainment industry where the switching costs for customers are practically non-existent. That's why the score is 1. Are there new competitors that can leapfrog current competitors' business model? Disney faces significant competitions from established players like Netflix and Amazon, as well as emerging companies leveraging technology. These new entrants could potentially leapfrog Disney's traditional business models. That's why the score is 1. Let's talk about the leadership and ownership. The chairman for the company is Mark Parker, and the president for the company is Robert A. Iger. While the board composition, total directors for the company Disney are 11 and independent directors are 9. Total directors for US average is 9, and while the independent directors are 7.2, that makes Disney uh, a cut above for the independent directors in comparison to US average. Let's talk about the institutional ownership. The US average is more than the Walt Disney Company. Let's talk about the WCB benchmarking. Profitable growth at Disney has seen slight improvement over the years, ranking in the top 60% among 240 large communication services companies worldwide. Growth has been bright spot for the Disney recently after struggling with a rank of 9 in 2021. Growth has climbed to 2 in past 12 months. Asset efficiency has been challenging, ranking lower in the early years but showing gradual improvement, reaching 6 in past 12 months. Revenue growth declined to 5 from 2 in 2022. Expense direction initially ranked low at 9 in 2022 but has since shown a remarkable recovery, climbing to 2 in past 12 months. So you can see here profitability, there is a slight improvement, while growth, there is a massive improvement. And let's talk about asset utilization. There is a slight increase. Net margin, you can see improvement. And while we talk about sales growth, it has declined to 5th decile. And if we talk about net margin change, there is a massive improvement for the company. Let's talk about ESG. Overall, Disney scored a 67% here. Environmental, they scored 60%, and it's because of the companies. It's because company is also included in the controversies. Like, does the company has resource reduction policy? The company goal covers science-based target for scope 1, 2, and 3 emissions, water stewardship, water reduction, sustainable design in the construction, and the use of most sustainable materials in their product. Has the company faced any environmental controversies? The company has faced several environmental controversies over the years, primarily related to its practices and impacts associated with its theme parks and film productions. If we see social, they scored 100%, while for the governance, they scored only 40%. This is because the company, if we see, Disney has not had a shareholder rights plan since 1999, although its governance structure incorporates elements that protect shareholders' interest. Does the company have any insider dealings or accounting controversies? Yes, the company has encountered some insider dealings and accounting controversies over the years, primarily related to governance issues and transparency. If we see the profit and loss statement now, you can see that revenue is increasing. With that, the net profit has also increased. Now let's talk about the cash and short balance sheet asset side. And if we see cash and short-term investments, it has declined. It's because of the share buyback plan that Disney has introduced, and also dividends they have introduced in the same year. Now let's talk about the long-term debt in the balance sheet liabilities and equity side. You can see that long-term debt is continually decreasing. It's because of the company's initiative to decrease long-term debts. Now, if we see the capital and expenditure, it's been increasing over the years, and dividends paid has also been increasing, while the change in equity, you can see that there is a decline in the year 2024. Let's talk about ratios. And if we see cash conversion cycle is negative, which is good for Disney. More on the ratios. And this is free cash flow data for Disney. Now let's talk about the relative valuation. On the forward 2025 PB multiple, Disney looks cheaper compared to the telecom sector in the US, Asia, and the global markets. The low ROI combined with the PB ratio signals potential underperformance in terms of profitability, even as the market values Disney at a relatively lower multiple compared to its competitors. Let's talk about the PE and PEG multiple. On the forward 2025 PE multiple, Disney trades at a significant premium to telecom sector. Disney's expected earnings per share growth rate for 2024 and 25 is much lower than in previous years, signaling that the market's growth expectation for Disney might be moderating, potentially questioning whether the higher valuation is justified. Let's talk about the valuation and target price. I assume a risk-free rate of 3% and a market equity risk premium for US market of 9%. Disney has a moderate beta stock, so I assume a beta of 1. This results in a WACC and a discount rate of 8.8%. I use a terminal growth rate of 2% and a free cash flow to firm to value Disney. I anticipate revenue growth of 5.9% until 2028, leading to a value of $70 per share. This represents a 26% downside compared to the current market price. In the sensitivity analysis on the following page, the optimistic case assumes a terminal growth rate of 3%, resulting in a target price of $82. Conversely, in the pessimistic case, the terminal growth rate is assumed to be 1%, yielding a value of $61 per share. So this is the sensitivity analysis, and you can see the terminal growth rates from in the FCF, in the optimistic case, and in the pessimistic case. Now let's talk about the risks, economic and market conditions. Economic downturns, inflation, or exchange rate can reduce consumer spending at Disney's parks, decrease advertising revenue, and negatively impact demand for Disney's branded products. Highly competitive field. Disney faces intense competition from other content creators and streaming services, which may affect its ability to attract viewers and generate advertising revenue. Let's talk about high dependency on single segment. Experiences is one of the major segments for Disney. It gives almost 70% of profit alone. So health concerns like pandemic, natural disasters, and adverse weather conditions can lead to temporary closures of Disney's parks and resorts, resulting in extreme loss. Cybersecurity threats. The risk of data breaches and cybersecurity incidents poses a significant concerns for Disney. Such events could compromise sensitive consumer and company information, leading to regulatory penalties, reputational harm, and financial losses. Ongoing CEO succession planning. Any misstep in this process could lead to further instability and uncertainty for Disney, impacting investor confidence and operational continuity as the company navigates a challenging media landscape and evolving market conditions. So this is where I end my presentation. Not so Disney-esque story after all. Thank you.
All right. Let's go. Let's go through some of the questions that we've got. And the first one comes from AG. She says, "I see high dividends and share buybacks in the same year. Why do you think Disney is being so aggressive with share buybacks and dividends?"
Actually, so they just ceased paying dividends because the net profit came down, and it's because of the COVID. Disney's, as I said, that net profit by segments, if we discuss that, experience segment gave 70% of net profit, and when this profit was not coming, their net profit actually came down to a lot less. If we see there, just a second. If we see the net profit here for the years 2021, 22, and 23, you can see that there is a massive decline there. They were earning 8 billion profits before that, and it's decreased. That's why they stopped paying dividends, and now their share have fallen to more than 50%, and that's why they are being aggressive right now. They want to hold on the investors they have.
Okay. And next question, also from AG, says, what catalyst would change your recommendation from a sell to a buy? After all, the share price is falling pretty aggressively.
So one of the things I have been discussing in the risk is ongoing CEO succession planning. Disney is actually going into the second transition for CEO in the next, like in just 3 years, and I'm hoping that if James Gorman comes in, it would be a really good succession planning for Disney, and it could help Disney with the growth. This could change my
Okay.
prediction.
Okay. And Jack Torrance says, what's the reason behind the CapEx increasing a lot in the forecast years?
Okay, so the main reason is actually inflation. Like, let's suppose if I give an example of a movie like Avengers in 2012, they were actually spending like 200 million on the budget. While now, if I see a spin-off movie like Lightyear, which is actually a part of Toy Story spin-off, and it's an animated movie, they are spending 220 million. So that's a lot of increase in the money from 2012 to 2024, and that's why I'm assuming that capex will increase too, and profits will increase too, and the revenue is going to increase too in the later years. Like you can see, um, just a second, you can see that my revenue is increasing too.
Yep. Okay. And another question, why do you think people have stopped watching Marvel movies, and how will this affect Disney overall?
I actually gave the answer in the stories, but it's just the entertainment market is so matured. Like, let's just take an example. I grew up watching Marvel, and I have become an adult, and I'm bored with the movies now. So I don't want to see that. And when the Marvel movies were coming in 2012, that was the time when the growth was coming in. That was the time when people wanted to see the movies. But now it's just, market is just fatigued with franchisee and reboots. They want to see something new, and Disney is not doing anything new. I saw their investor relations page, and they are just making more Avengers movies, making more Star Wars movie. Star Wars is actually coming up with the 11th and 12th part. Does it actually need it?
Mm. Yeah, I mean, it's kind of amazing about Disney because, it's just got such a brand and such a long, great history. To see it in this situation is pretty awful. But one of the things that I thought was a bit surprising was you were talking about the international not being, that strong or profitable. And I thought, I mean, everybody loves Disney. Why can't they get more out of international?
It's just they have been trying with the entertainment segment, but if you see that international market, it's still low with the Disney parks. Like, experience segment is not that much in the other countries as much as they have in the USA. That is the main reason for this, and they actually are taking efforts to increase the Disney parks in the coming years. That's why they have given the statement of 60 billion dollars, like US 60 billion dollars in investment across various projects which are international and which are going to be Disney parks and like the experience
Can,
segment.
can you go to the quarterly data again? Um, is there was a massive increase in what year was it? Oh, okay. So let's say recently we've seen a strong number for profit. Um,
Mhm.
if you now go to your ratio page, I want to look at the ROE. Yeah, next one. So in the quarterly data, we show a lot of volatility in the recent quarters from 7.6 to 0.1 on ROE, negative, and then 10.5. That increase that's happening in June of 2024, the latest quarter, Is that
Mhm.
a one-off or is that sustainable? Because if I look at the actual ROE in the years, it's 2.3, 3.4, 2.4. Can you just talk about what is it sustainable or not? What's happening on a quarterly basis?
I don't think it's sustainable. It's going to increase a bit, but not to the average that they're giving right now. Uh, if
Okay.
that answers the question. Yeah.
Yeah. Okay. Hold on. So how does it feel to graduate from the Valuation Master Class?
Oh wait, just let me just switch to the screen. It's been a problem here. Okay, so it feels amazing actually, and in the 3 months of the period, I actually made a lot of friends here and learned a lot from you guys, Momin, you, and Pete. It was all. I just feel like I'm going to miss this period a lot, and that's why Zishan was saying that we should join Bootcamp 18, which I was just actually thinking we can do that, but then again, it was amazing period for me.
Well, you can help the Bootcamp 18 students get the great experience that you got.
Oh, of course, I'm going to do that. Everything for
Yeah.
this bootcamp. You guys helped me a lot with the stuff.
Let's talk about your transformation. Like when you came into the boot camp, I'm thinking about a military boot camp. Here comes, here comes another young kid into the military boot camp, and when he left a man. What is the main transformation that you went through as you went through the valuation masterclass?
Actually, you saw my transformation. I used to have long hair and then beard, and now I'm like clean shaven, like an investment banking. I'm looking actually, but yeah, the transformation, it actually gave me a lot of confidence. If you see my presentation in the boot camp that I gave, I actually said something like I was nervous, but when you see it now, I'm actually really confident right now.
And you should be. You should be. We gotten a lot of ways to go. All right. Well, congratulations on that. And let I'm going to take you out of this, and I'll come back and talk to you in a second. But well done.
Okay, thank you so much.
Yep. Wow. And look at all the nice comments that have come in. Way to go. So that was a very interesting discussion about Disney. And as you can see, Yash has spent a lot of time on that research. And I would say looking at Disney on a return perspective, looking at it on a DCF perspective, looking at it on a multiple perspective, it's expensive. The only thing I didn't ask, which I think is the next big question, is could they really dramatically turn around their returns? If they could take their ROE from 2 or 3% up to 15%, okay, now we're talking about a real potential to see the company share price fly. But as of now, doesn't look like that's happening. If you want to build a competitive advantage in company valuation like Yash has, then join the Valuation Masterclass Bootcamp. Just go to valuationmasterclass.com and click on Bootcamp.